Now we're going to talk about what margin level means. The margin level is a percentage value based on the amount of equity versus used margin. Margin level allows you to know how much of your funds are available for new trades. The higher the margin level, the more free margin you have available to trade. And the lower the margin level, the less free margin available to trade, which could result in what's called a margin call or a stop out, which we're going to talk about in a minute. But basically, your broker will start to close negative trades in a loss. Calculating your margin level is very easy. And like I said, your trading platform will automatically calculate all of these numbers for you. But understanding what these numbers mean is important. If you don't have any trades open, your margin level will be 0. Margin level is used by the broker to determine if they will allow you to open any more new trades. Different brokers set different margin level limits, but most brokers set this limit at 100%. So when your equity is equal to or less than your used margin, you will not be able to open any new positions because your margin level will be 100%. You would have to close some trades if you wanted to get into any new trades in order to free up some margin. So I like to think of margin level as being a stoplight. As long as the margin level is above 100%, then your account has the green light to go ahead and keep opening new trades. The only time your margin level would be 100% would be if the equity and used margin were the same, which is not good. With most brokers at this point, it would be a margin call. So now let's move on and talk about what exactly that means. So what does margin call level or margin call mean? In Forex trading, the margin call level is when the margin level has reached a specific level or threshold. When this threshold is reached, you're in danger of the possibility of having some or all of your positions forcibly closed or liquidated. For example, most Forex brokers have a margin call level of 100%. This means that if the margin level in your account falls to 100% or lower, a margin call will occur. So what is a margin call? A margin call is the event when your broker notifies you that your margin level has fallen below the required minimum level, or below the margin call level. A margin call occurs when your equity is less than your used margin. This would occur from having a lot of negative trades open or large negative trades open. Now, a lot of times traders confuse margin call level with margin call. A margin call level is simply a threshold set by your broker that will trigger a margin call. For example, the margin call level can be 100%, but a margin call is the actual event of you reaching that. This is when your broker will notify you that you've hit that level and that basically you're in danger. At this point, the account will be unable to open any new positions until the margin level increases to a level above 100%. So what happens if your margin level goes below 100%? If your trades keep going even more negative, you may hit the stopout level, which is the level at which the broker will be forced to close your position. So let's talk about this stopout level in a little bit more detail. In Forex trading, a stopout level is when your margin level falls to a specific percentage level in which one or all of your open trades are closed automatically by your broker. This liquidation happens because the trading account can no longer support the positions due to lack of margin. If this level is reached, your broker will automatically start closing out of your trades, starting with the most unprofitable one until your margin level is back above the stopout level. So this act of closing your positions by the broker is called a stopout. For example, let's say the stopout level is at 20%. This means that your trading platform will automatically close your position if your margin level reaches 20%. So let's say you already received a margin call when your margin level reached 100%. You could at this point deposit more funds, and that would increase your equity, which would then increase your margin level. That way you're no longer at the 100%, you're above the 100%. But let's say you decide to ride it out hoping the market will turn around. But the market doesn't turn around and your margin level gets all the way down to 20%. Now your broker will automatically start closing positions starting with the most negative. This will then free up some used margin so that your margin level percentage increases and you can keep trading. If you were just in one really bad trade, then that one trade would be closed and you would be left with hardly anything in your account. The stopout level is meant to prevent you from losing more money than you have deposited in your account, so it's actually a good thing. If it weren't for the stopout level and your trade continued to keep losing, eventually you would have no money in your account and you'd end up with a negative balance. Then you would owe the broker money, but the stopout level prevents that from ever happening. Remember, every broker is different and may have different margin call or stopout levels, so make sure you figure these out and you test it on a demo account on whatever broker you plan on depositing live money into. To figure this out for your specific broker, it's really simple. Like you can see here in the bottom right, all you have to do is go to whatever broker you're using, go to the live chat support and ask them, hey, what's your margin call and stopout level? And then you can see here that they'll just tell you, for example, here, our margin call and stopout levels are 70 and 50%. So you can go ahead and do that, go to your broker, and ask that question. All right, so now I want to show you this in the MT4 platform, but before moving into the MT4 platform, remember to calculate margin level. It's the equity divided by the margin times by 100%. So if we go in here to the MT4 platform using that same example, you can see here we have the equity of 917. If we divide that by the 211, which is our margin or used margin, then that's going to give us about 4.33. And then you can see we multiply that by 100%, and that gives us 433% for our margin level. So depending on your broker, you're probably safe at 433%. You probably haven't reached the margin call level and definitely not the stop out level. So we know that we're good to go here. Now, what I want to show you is I want to get into a lot of trades and use up a lot of our margin so that we don't have a lot of free margin left. And I want to show you what that does to the account and to these different numbers down here. So I'm going to go ahead and get to a bunch of buy trades at a 0.5 lot size here. So I'll go ahead and click this a few times. All right, perfect. So you can see here that I just got into a bunch of trades here, and you can see that it's added up all the margin or deposit that was required for each of these trades. And my margin is currently at 911. You can see here that the equity minus the margin gives us the free margin. So we only have $50 or $46 right there of free margin left to use as a deposit. So actually, if I try to get into another 0.5 lot size, which requires, about $100 as a deposit to get into this trade, then you'll see it doesn't even let me, right? So I can't even get into any more trades now because I don't have enough free margin to be able to trade with. So you can also see here that if we take the equity divided by the margin, that gives us close to 1 because these two numbers are almost equal to each other. It gives us about 1.1. And then you multiply that by 100%, that gives you the margin level, which is currently at 109%. So at this point, you definitely want to be really careful with your trades, and you may want to free up some of this margin by closing out of some trades. For example, these that are in profit, you may want to close those trades out so that you can free up some margin, and that way you don't run into any issues with your broker by having your margin level percentage get too low. So for example, I'll close out of some trades here. Close these out in profit, which is great. There you go. So now you can see my equity has gone up, which is great. And you can see that the margin isn't as high as it was before. And you can see my free margin, which is my equity minus my margin, is now at 503. And my margin level has also gone up to close to 200% because that's calculated by taking the equity divided by the margin, which gives us about 2 times 100%, which gives us about 200%. So that's a way to free up margin, is just by closing trades. Because if you remember, margin is just a deposit. It's not a fee. It's not something that the broker charges you. It's just a deposit that the broker acquires and holds on to that deposit until you close the trade. So once you close the trade, that's what frees up that margin. That margin goes back into your account, allows you to have more margin to trade with, and is obviously going to free up more margin so that you have a higher margin level percentage as well, and you don't get stopped out by your broker for over leveraging your account. So I hope this has helped you to see how all these numbers are calculated. If you still don't understand how to calculate one of these numbers or exactly what one of these numbers means, then you can go back and watch the sections that we went through. But after these sections, you should definitely understand what margin is. It's the deposit from the broker for each position you get into, added together. The free margin is how much margin left that you have to trade with. So if you want to get into new trades or for your trades to move against you, you have that much free margin left. And then the margin level percentage is really important because if that percentage gets to the margin call level, then you're going to get a warning from your broker that it's getting too low. And if it gets to the stop out level, that's when you're in trouble and the broker is going to start closing out of your trades, starting with the most negative trade until your margin level percentage gets back above your margin call level percentage that's required by the broker. So that's about it for margin. I hope that this has made sense to you and has helped you to understand these numbers here in your MT4 platform and the importance of these numbers in trading manually.